This conference will now be recorded.
Hello, good evening, Merry Christmas. I was speaking to my friend the other day and he said, "What do you mean you're doing a webinar the day before Christmas Eve? You must be a maniac." And I thought, who else can be an equal maniac than myself to talk about FX the day before Christmas Eve? Beat is in the house. Hello.
Hi, Patrick. How are you?
I'm very well. Can I just clear something up? I
Yeah.
didn't do that to you, did I, B?
No,
We
you
didn't
didn't.
pull out of the markets.
No, you did not. That was a silly accident of myself a day before Christmas. But anyway, I survived it. A
Well
little
done.
bit
You know,
bruised.
you braved it here. Well done.
Yeah.
That's fantastic. I mean, you know, that is, you see, that's true dedication.
That's true
So,
dedication.
exactly. So we just we're going to do a one-off special tonight. Keep it short, sharp, and succinct because I know, you know, many of our viewers and followers on LinkedIn and Money Maven have got families to go to, of course, and you know, and tipples to drink. So I just the big thing that we want to talk about now is 2008. What happened in broad dollar terms? What happened in broad risk terms? What I expected to happen and what didn't, and then we'll go through some sort of topics as I post on LinkedIn, and then really quickly we'll talk about Q1 next year.
Yeah.
So I think the first thing for me was there was so much talk on the dollar having a tear up because we broke, you know, key levels. We broke 3% on the 10-year. 30-year was being around 3.15, 3.2. That was significant. I think it was the 100-month moving average. There was certainly a massive trend line. You had Bill Gross and Gundlach saying, you know, it's all over for bonds. You know that we are now in a bear market. For those who don't know who Gundlach is, Google him. He's a bond titan, and the other bond titan is Bill Gross, ex Pimco, right? Huge guy. So we're all thinking, right, 10-year, 3%. Then we're all thinking, 10-year, will it? 3.15. Then we're thinking 10-year, no, surely can't do 3.25. It did. And then when that hit, everyone was selling the 10-year treasuries, lifting, and I was just expecting a resurgent, another massive leg up for the dollar, but it wasn't to be. It wasn't to be. We failed. We did touch. We took a kiss 3.25% on the 10-year, and then we failed to stay above 3%. We cracked 2.8, which is another massive level. 2.6 is the next massive level. I think we went to 2.7-ish, 2.75, but 2.6 is on the radar. The longer we stay below 3%, the more downside the dollar has for me. And just to kind of build around that, I just think there's, in broad terms, on the yearly terms, I just think the dollar bulls had their shot, right? Is this them licking their wounds, going for another go, or are they going to throw the towel in? What do you reckon, B?
To be honest, like we discussed in the last few months, the dollar had many opportunities to rally and rally strongly, and especially if you look at the euro, it was actually the biggest disappointment that you could imagine, as we just traded water like since June. We had this big move, dovish ECB in June, 118 to 115 in literally 24 hours. And then the rest is history. So we ranged 15, 17 for ages. We had the Turkey incident, which finally broke 115, briefly go down to 113, just for it to sort of come back once Turkey slowed down. And then we had one more episode when suddenly the market realized that actually Brexit could go horribly wrong, and we broke 113 briefly to go to whatever it was, 112, 20, 25 before we sort of came back. But if you just look at the euro dollar graph here, which you just show, you know, really, since we had this big move down, we had this one, the big flat one you have there at 115, and of course that is now going to be the sort of big resistance on the way up. But in terms of if you bought dollars in, you know, if you're lucky you bought dollars on the ECB day, if not, you haven't really gone anywhere, because you had to be very quick to sell euros before 115 on that day, and we like 113.70. So really, you wasted your entire 6 months. The problem around the euro, around the dollar, is the difficult discussion to have for Q1 if we look a little bit forward. I totally agree that dollar yen for me is already my first Q1 2019 trade. I think dollar yen is going to go down to 100, not in Q1, but you know, Q1, Q2.
108 I see first.
Yeah. I just had a sniff. I sent something out last week looking at the monthly, and I just tried to see, okay, where would be my real bigger next target, and I sort of came up with 100, whether that be a 102, 103, who knows. But to be honest, I think the best is behind us in the dollar, but there's the problem. We're going to have this big Brexit story coming back in Q1 as soon as the UK government is coming back. And as things stand, it's just the risk remains of stumbling into a no-deal Brexit, which obviously will put some decent pressure back on the euro. So that, I think, is going to be the challenge for Q1, because we may talk dollar because euro dollar is 60% of the XY, and if the euro dollar is under pressure due to Brexit and the European problems, the broader market might actually think it's a dollar move, which it will not be. As I only see downside chance for the euro if it's based around Europe, which it will be in the first 1 or 2 months, maybe the first, really the entire quarter. It's very hard, like we argued many times, you know, to come with a solution around Brexit. Is it no deal Brexit? Is it soft Brexit? No Brexit? God knows what. Right now, if Parliament doesn't get the act together, it's going to be a no deal Brexit, which means the euro is going to be lower. There's a chance of maybe go back to 110 or below. But again, that's just not a trade you can take, because I would be a dip buy in the euro, worried not for Brexit. Not because I love Europe, not because I think European data is great. I just think that we haven't heard the full truth from the Fed, like we talked about it offline. I think JP could only give us as much as he did give us, which is cutting the dots from 3 to 2 hikes. But you know, he couldn't go from 3 to 1. Obviously, that would have created even more panic. But to be honest, I firmly believe, and some of the key sentence, I think I sent them out last week when they said about judging the next rate hike. Judges, you know, judging means nothing else than watching data. They mentioned global growth, which is the next concern, why the stock market probably collapsed. And they even talked about slower growth in the US. So everything that the stock market didn't want to hear. And so I think we shouldn't be betting on the dot plot. I think the dot plot is just there. You know, it's redundant. I think if you read between the lines what JP Powell said, the economy is okay, it's ticking over, but it probably will not re-accelerate, which will not necessarily mean we need accelerated hikes. I think March, we're not going to see a hike in March as things stand. So, and that all will weigh on the dollar. So I would say the dollar, or what I started to write or think last week, is we have to select the correct dollar to be short. And that is the only one for me right now is dollar yen, because Aussie is going to be heavy for the same reasons, risk of China, the same reasons we had in 2018. Many of the other dollars are basically the risk off stuff again, which fights with the market. So, you know me well by now. I always look for the easiest trade. 2018, the easiest trade for me was short Aussie dollar. For all the reasons: bullish dollar, bearish stocks, bearish China, bearish risk overall, and the dovish RBA. And now when I think about 2019, the only dollar I can think that I have more than one reason to be short is dollar yen. It's going to be risk off, it's going to be pressure on the dollar, it's going to be pressure on US yields, and there's no other dollar right now that you could sell that fulfills all those criteria. So I'd be probably starting euro dollar. I actually hope that we're going to go up to 116, 117 by year end in the euro. So we have a very lovely level to actually sell euro dollar for Brexit. Now we want 1370, so it's as unattractive as it has been for the last 6 months. So, I will just patiently wait for the euro dollar side of it. But that's sort of my first sort of take, that I think the Fed is more dovish than people give it credit. But it's maybe just my view that I feel that, after studying Powell very intensely in the last few weeks, and you were kind enough to send me one of the links as well from the interviews, and the more I sort of listened to him, the more I understood how he thinks, the more I'm absolutely convinced that he's moving to a different policy than we were used on the Yellen and Bernanke. And he will try to get rid of pre-committing as quick as 2019 starts.
We're definitely getting there. There's some legacy from Yellen, which is a bit of a poison chalice. The biggest legacy for me is the optimal control, lower for longer strategy that Yellen had kind of invented. And for those who don't know or don't know what this is, it's on Wikipedia or investing.com or one of these websites. But let me just sort of really briefly tell you in broad terms, it just means that in broad terms, the rate path will be much, much lower for longer, but the acceleration later on will be higher. And this is something we're getting to. So, this is the idea that you give inflation an absolute, the best, and growth the absolute best chance before you start raising rates. But obviously, it doesn't seem to be working. I know the dots were lower, and I just think at the moment, I don't think I absolutely agree with you, B. I think Powell doesn't want them, wants to get rid of them. I don't think we're there yet. I think at the moment, I think the market took the dots. I expected the dollar to get hit more because it was more than 0.2 on 2019. I think it was from 3.1 to 2.9. And then it was obviously 0.2 on 2020 and 2021. But I think the market took the comments on global growth, and obviously the risk off was precedent. But I just think there is still some credence in the dots. That will change, and it's changing, especially with the words like judging and every meeting live and all of this stuff. I think we're definitely getting there slowly but surely.
And we have a more dovish Fed for 2019, like we already mentioned, right?
Because you've got exactly. You very kindly got your cheat sheet coming in a lot more dovish members.
Yeah. To be honest, maybe on a side note, which surprised me as well a little bit, I read over the weekend. So the Dow had the worst week since 2008, and the S&P had the worst week since 2011. So some really serious stuff has been happening. Okay, we can try to explain it with a little bit time of the year or whatever, but the reason I'm just remain bearish is if you think about the entire up moving stocks that, in my opinion, have gone way above, way further than anyone would ever have thought. So I think this whole, move down has a lot more room to go, just for the fact that I still think the highs we've seen in stocks were just extremes. And I think even back then, Powell did agree about, I think not last week, not last meeting, but the one before, when one asked about stocks. I think it was a separate interview. I think actually the one that you sent me, where he actually said, yeah, stocks are high. Like, so that's why I just feel like we always said, there's no Fed put, there's no Powell put in stocks. Well, this was one of the reasons last week for the market to realize why we accelerated the sell-off. I don't think it's just global growth. I think, what we've seen last week was a perfect storm in any sort of way. And the market just gone on panic. You saw it on the yen crosses that moved, probably the biggest sort of multi-day move we have seen in some of the crosses, Aussie yen, CAD yen. It was just going, and we can again look for many sort of explanations why now, but it's just a move that's probably stored up. And even in euro yen, and that's where I'm coming to for Q1, if I would be right on dollar yen, and if I think euro at best is just somewhat sideways to small lower around this Brexit stuff, I would expect euro yen to roll over a lot as well. I haven't set a target there yet, but it's a lot lower than where we are now, which I still expect euro yen to roll over dramatically. But that will need probably the sort of European side next week, next quarter. The other thing we briefly touched, which is something that is only just on my watch list, not yet on my reaction list, is yellow vests in France.
Yeah.
I think for 2019, if things in Europe continue as they are, it's something to be watched that could spread in Europe. I think the discontent in many of the countries among those people that just finally realized that 10 years of those kind of policies we have seen, it's just people struggle to meet their ends. And you see it in France. When I saw some of the interviews with people on the street, those are not, of course, you always have the hardcore troublemakers. But a lot of the people that have been on the streets is your normal moms and pops. It's not like radicals or anarchists or whatever. Yeah, we can argue the French are always the first ones, but there is pain in Europe among a certain area of society. It's actually quite a big part of society. So I think Europe could actually have a big problem in 2019 that is not yet on the radar. And hopefully I'm wrong, because it's something I first looked at in 2008 to 2010, and I was worried that this could happen. Maybe it needed this 10 years of the kind of policies we've seen to actually really drain out people. So it's something. So that's again going in my basket, where it's very hard to decide what the dollar. Because when we talk dollar, we always have we have the euro dollar, and we have, let's say, the dollar in the other dollars, and it could be a battle between the euro and the dollar. And like what we, I think, discussed last week or the week before, there's so fine-tuned differences. Fed is a bit more dovish, and now the ECB is a bit more dovish, with some talk already the hike could be pushed into 2020. Maybe the euro can't break out. Maybe we stay on 12, on 17 for many, many more months. That's actually currently my biggest worry. That's why we have to watch dollar yen. We have to watch crosses, especially the risk of crosses, rather than waste our time in euro dollar. I actually could make a case that euro dollar is absolutely, of course, if you trade one or two big figures, fine, right? Rallies to a big figure, you sell it, blah, 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 blah. So trading wise, it could be a good pair. Trend wise, as in macro, buy and hold, sell and hold, it's probably complete crap for another 3 to 6 months. I could see just a very boring range in euro dollar for Q1.
Yeah, very good. I mean, I'm just thinking about your yellow vest comment, and I know you mentioned it last week. I think for me, I'm thinking the nearest we got to that was when people came out on the streets was Greece.
Yeah.
I see France as different because, on the one hand, I don't know about you, but I wasn't particularly sympathetic with the Greek cause. We had the Finman coming over with his leather jacket on a motorbike, parking up by number 10, and playing the game theory to aplomb, and not really succeeding. So he kind of crashed and burned, and you had a lot of people taking on the streets, but I don't think their sympathy was there, and because, rightly or wrongly, because it's Greece, people were just kind of thinking, get your tax paid, sort it out. You've had it so good for so long, and all this stuff. Everyone has a second house. Half the house isn't finished, all this stuff. In France, it's slightly different, a bit closer to home. And if that kind of gets upset, I agree. It's definitely something for the radar. And
we had it spread again to Belgium over the weekend.
Yeah.
Like the week before, we had. I'm not sure this weekend if it went as far as Amsterdam, which it went last week. We have to wait for January, February. Now it's Christmas, so maybe people are not too. But it's kind of, I hear you about Greece, and I hear you as well that one part of France may be very quickly on the streets, but there's actually the police even plan to go on the streets, and they call it, I think, Blue West, right? And they want to demonstrate for the same thing. So the reality is, what you have to be careful is that, and not many news-wise did show that a few weeks ago, that before the demonstration started, the Yellow Vest shook hands with the police, right? They are on the same page. They fight for the same problems, right? So I'm just saying that this is probably, usually I don't take the French, no disrespect to anyone who's listening, too seriously when they go out and demonstrate. This is the first time I think it's different. And the cause is different, and the support in society is different. So whether it leads to something, I don't know. Whether it spreads in Europe, there's areas in Europe where it will not start, but keep an eye on Germany. It won't be West Germany, it will be East Germany. These guys are very quick on their feet as well. And Macron is just under pressure. His pressure is just mounting and mounting, and we could be in Europe. And if you mention the Greek ex-finance minister, I never can say his name, Voudourakis.
Varoufakis.
Yeah, I listened to a lot of his stuff about Brexit. He's actually very smart, and actually I like what he's saying because I think he's right. He is forming a party, and he will be in the European parliamentary elections, and he could actually come in, and that will start to become very, very interesting. So to be honest, as I said, it's not a trade. It's something that I have on the radar for 2019, whether or not Europe creates its own new problems. I'll be watching French bonds like a hawk, because at some point France is I think the European Commission said they're only looking at the French budget, I think, in spring. So January, February is probably not an issue. But
that's much higher than the Italian deficit, isn't it?
Yeah, to be honest, that's what the Italians go on about, right? Of course, the French has been a lot higher before and is in theory on its way down. The problem now is what Macron has done. France hasn't done any real reform since 2008. And I remember back in the Euro crisis, 2011, 2013, the market was always worried that France is the next shoe to drop after Greece. They weren't so worried about Italy. The problem is, and that's why the whole thing is so complicated, Italy, yes, has the biggest debt, but it's a legacy debt. If you look at how Italy worked in the last, 5 to 10 years, the debt has come from it has a longer legacy. French, they just have done nothing ever. So all the reforms that other nations did in Europe, France just got away with it don't know why, of not doing it. Of course, you know, they're among Germany the biggest in Europe, so maybe no one really wants to put pressure on them because they're the birth fathers of the euro or Europe. But in spring, you know, otherwise the Italians go nuts, right? Speaking of Italians, the Northern League continues to increase in the polls. They keep on polling down there in Italy because I think there is still the idea that the current coalition government will not last the distance, which I would agree.
Yeah,
will be worse.
I agree.
So that's another thing to watch, probably Q2 in 2019. Once the polls are strong enough for the Northern League, we could actually suddenly have them, you know, fighting each other, calling snap election, and you then suddenly do get a populist government. So I'm just saying 2019, I see a few clouds on the horizon for Europe. They may or may not happen. But our job, in my opinion, is, like, you know how I work, I'm always prepared for watching what stories could become a story, because at least then we know quicker what to do with it. And Europe, so yellow vests, French budget, Italy is on my watch list for 2019 in Europe. And of course, number one, Brexit. But, you know, who knows?
Yeah, I mean, exactly. That's fantastic. So, what do you make of global inflation with oil nuking? And is the only thing I mean, this is a massive story. Sorry, before that, I just want to really briefly talk about City Surprise Index. We've both been telegraphing this for a number of weeks in the US, right? So we're still largely pristine macro-wise in the US. There are no surprises. So the City Surprise Index, which is the go-to surprise index, there's nothing, and actually CPI's just taking a right old hit. We know it's oil, obviously. ISMs are hovering around 60, and we're not really going there. GDP's all right. The only thing that's slightly firm and upward trend is wages. After it was chopping for what seemed to be like forever. So the key thing for me after the City Surprise topic is, how long can this go on for? I don't think it can go on for very long. I think it's due for some lower revisions. I just think in a broad asset space, you know, equities off, FANG's taking a bath, credit spreads widening, you've got QT not going away, you've got all of this stuff, and you've got some risk off in politics, you've got some clouds that you've mentioned as well. And you know, I just feel CPI is an interesting one for me, because obviously headlines taking a nosedive. Core's stable, and the only thing that I've been scouring the websites, I've been scouring the wires. The only thing to support core CPI and CPI as a whole to a lesser degree, and providing it with a tailwind, is wages. So if this remains firm, it could be supportive. What are your views on that with oil, Pete?
To be honest, obviously we have sort of two different CPIs to watch. One is the European one, which with what we've seen on the oil price, it really just kicks. It probably kicks the first hike into 2020 rather than 2019, because it's something I've been watching for a long time, that even though we have wages going up a little bit across Europe as well, the correlation between energy and European CPI is just far too close. And you know, like you heard me go on about it many times, I just think it's very odd that the ECB still only has a single mandate rather than a dual mandate like the Fed. But anyway, having a single mandate means they already missed to hike rates, early in 2018 when PMI has gone through the roof, like growth accelerated beyond expectation of the ECB. And now they come into that window where they should hike, and suddenly the data just starts to fall off a cliff.
Yeah, they lost the window.
Right? So it's it's almost like a policy mistake in the making. On the US side, if I look at all the downside revisions across the world in GDP for 2018 and 2019, you just have to expect that sooner or later that this has to feed in the US. The US is obviously going to be last because they've been on such a strong growth path. But I just cannot believe that it would just, that the US can be isolated. We still have the trade war risks to come. Whether, Trump once said he could extend to 90 days, maybe he will. It looks like China is still pretty kind of willing to play ball, so maybe there is some sort of an easing from that side, but it has already hurt the US economy, right? The farmers, some of the other industries. And there probably could be a tricky part. So some of the goods in the US have gone up in price because of the trade war. So you could actually talk about that there is a floor, not just from energy, not just from wages, but from other areas, like a small floor around CPI. But it's a wrong kind of inflation, if you know what I mean, right? If the additional upward pressure on inflation is actually just coming from slower growth, in a sense that you just have to pay more for the goods because there's tariffs on it, it's not a healthy, it's not a good CPI, and it's almost like, if you remember the Bank of England when we had the big drop in sterling and obviously the impact on CPI, while the economy started to tank, you just can't just start to hike rates just because CPI overshoots because of sterling or the currency impact. And so I wonder what Fed is going to do should CPI pop its nose above the levels for the wrong reasons. To me, JP sounded he was willing to look through a higher CPI if it were driven by oil. Now suddenly oil is not an issue. So it'd be interesting to see how he formulates if CPI would poke its nose up for the wrong reasons, whether if he's willing to look through that as well as an overshoot rather than a trend. So the last thing on this, I would say, and I'm no expert, I've just started reading about it, is that there's a lot of chatter about the new wave of deflation in China. And last time when we had that in China kindly enough exported deflation to the rest of the world, right? So, I think it's unclear, to be honest. I really think the Fed is going to have its work cut out in 2019 between a somewhat weaker economy and maybe lagging impact from wages from some of the drivers that are driving it now. And I wouldn't be surprised if he's just going to close his eyes, look straight through it. And I still believe we may only see one hike in 2019. I really do. But that's where, there's a lot of different opinion out there. But I think the only thing for us to do is actually to adopt what the Fed is telling us and what JP is very adamant of telling us, watch data. We might have to start to watch new data. We only watched CPI and wages this year. Maybe it's time to start to watch what we used to watch,
Well, soft data.
Tier 1 data, right? And start to maybe some of the interesting tier 2 data. Maybe we have to broaden our data watch for 2019 to really understand what is actually happening to the US economy as a whole, rather than CPI up or down, its wages up or down. I think 2019 we're going to have to watch a lot more data to actually understand. And you know what? The more you understand where we stand, the more you will understand what the true Fed policy is. I think he will not pre-commit. The dot, I agree with you that he can't get rid of the dot plot, but he's not committed to it. I mean, he's just gone from 3 to 2. And if March goes like, you know what, it's going to be from 2 to 1. So it's not a real, it's not a real, because they not commit to it, there's no reason to take it for granted. And I just maybe have the wrong view, but I just think that's why I keep on thinking the Fed has a different agenda and he's leaning towards that, but he's not pre-committing on that side either, right? So I have to be consistent. So all he tries to manage is, listen, a few months ago we thought we're going to hike 3 times the risk for 4. Now we kind of gone from 3 to 2. It could be 1, it could be 3, right? So it works both ways. But if we predict that we have a slowdown in the rest of the world, the chance for us to be surprised on the top side is probably unlikely. That's where my view is coming from. It's more like, if I look across the world, I still expect some severe downside on equities. I just don't see it. I really don't.
The other thing I was talking about with CPI in question is let's just cut this to the chase, right? The oil that's been nuking, right? Actually, this hasn't really played out into CPI yet, right? It's
Not
only
yet.
just no, and that's to come.
Yeah.
So, and the other thing about that is everyone says, yeah, oil's on its arse. CPI is going to be, revised lower. All the rest of it. It actually affects everything else because of the production and manufacturing. So that all goes into GDP, goes into wages, goes into everything, and we haven't realised that yet. It goes into share price. This I think it's 40% down year on year. Oil.
Yeah.
So just everyone's like, yeah, dollar CAD's up, oil's down, and there's a bit of risk off, and this is nothing. That hasn't actually played back into these other bits of data.
So that is still to come. Totally, completely agree.
That's great. Well, so I guess is right for me. Dollar yen's the easiest dollar to sell if you're selling dollar. I quite fancy selling dollar. However, as long as there's not another bloody roadblock, and that was a smoothing from the BOJ MOF, if that was hedging, if it was the 11 yards you were talking about, or whatever, if there was a roadblock before, there might be a roadblock again. So please, no more roadblocks. Can we just have a proper
Well, to be honest, the only way to get around that is you have to have short dollar yen and you have to have short yen cross at the same time, because that is what I missed now last week. That still hurts me a lot. Hurts as in opportunity loss, given that I've been short Aussie yen and Euro yen most of second half of 2018. It's like we saw again, the moment dollar yen hit the roadblock, Euro dollar sold off, Aussie sold off, dollar CAD exploded, and it's just something, if you're a risk bear, if you think there's more to come, you probably have to have two. You have a dollar and you have you need a non-dollar as well. And to be honest, because we highlight the Q1 with second week of January, Brexit discussions are coming back. That's probably the time when Euro yen could roll over on the downside. Whether it's the dollar yen the driver or Euro dollar the driver, if you short Euro yen, you don't have to take a pick. So I'm gonna be short dollar yen, and at some point I'll be short Euro yen again. So those are probably my first 2 trades of 2019. I still hope to get Euro dollar a bit higher, so I get a bit better levels for Euro yen. But I don't mind. I just sell the first rally in Euro yen.
I think I had an offer at 114.95. I think the high was the 3 or something.
Yeah.
So that was nice. Thank you, Santa. That's trading, and that's fantastic. Well, you've got it here, you've got it real. Beat it myself. just have a great Christmas, everyone.
Yeah. Merry
And
Christmas.
it's just been a fantastic, we've been doing this a little while now, and it's great to have you on board, Beat. And before I go, Beat has done amazing commentary, and it's really is. He puts tons of work in it, and there's loads in there. There's levels, there's macro, there's technicals, there's fundamentals. It's rammed, jam packed to the rafters, and it's not one email a week, right? It's not one email a day, right? It's many, and it depends. If it's busy, you get it. If it's not, you'll get his 2 cents. So, B, I think I've said it all, but I'll let you have the final word on that.
I mean, to be honest, for some people, it might actually. I never had a complaint when people get 40, 50, 60 emails a day, because that's what it's sometimes adding up to. So basically, as Patrick just said, so what I do is I do all the charts of the majors, put my sort of spin on it, my research on it, the theme on it. I send news out during the day that I expect, what I think is important. I sort of put my channel views into that. And I think it's just something that is probably somewhere between an economist and a trader. So what I'm trying to do, and what we do here as well on our session, is breaking down macro in a tradable trade, which I think is what's sort of probably missing out there. You either get the economist side or you get just the short-term trader side. But what we try to do, what I do is my product is just really break down macro into a trade. Because one thing is macro, if you don't know what to do with it, it's not a lot of help. And so if anyone is interested, you can ping me or ping Patrick, and we give you some more insight into that. Thanks, Patrick.
Thanks very much, Pete. And just have a lovely Christmas, and everyone.
Lovely Christmas to you.
We're both going to be pretty light this week, and for obvious reasons. Shame Mark can't open Christmas Day. If they were, I'd be blogging. I'm sure Pete would too. But it's good year for us, and a well-earned rest for everyone.
Yeah.
And have a lovely Christmas.
Merry Christmas to you too, and everyone who's listening. All the best. See you.
Bye.
Take care.